Welcome back to the Real News Network. We're with Greg Gordon coming from the McClatchy offices in the Real News studio in Washington, D.C. Thanks for joining us again, Greg.
Glad to be here.
So in part 3 of your series on Goldman Sachs and the subprime mortgage orgy, okay, that's my word, not yours, you talk about the way Goldman Sachs and other banks went offshore to the Caribbean, to tax havens, to give their clients tax shelters, but also to shelter themselves from potential repercussions of selling such junk. Tell us the story.
We don't exactly know when Goldman Sachs joined this frenzy of offshore wheeling and dealing with respect to subprime mortgages. Goldman was a latecomer to the subprime game on Wall Street, and it was the first to get out and the only one to get out safely. But in the middle of the height of all this, Goldman was doing a lot of deals. According to a calculation by a securitization expert named Gary Kopf, Goldman had about $83 billion in offshore deals, many of which were or included subprime-related mortgage securities. These are very complex deals because in many instances, there are no mortgages directly underlying the securities. You might be buying a security that rises or falls in value based on another underlying security. And these deals are really a Wall Street creation that I guess would be characterized as ingenious. But the foreign bankers now say privately that these offshore deals, and particularly those in the Caymans, were sort of the platform for selling subprime-related assets or passing subprime-related risks off to foreigners who saw a AAA rating on the bulk of the securities and felt safe.
To say again what subprime is. This is probably an ordinary person who gets a loan to buy a house and that with a salary level that doesn't justify that loan, or a student who probably is not going to have the real possibilities of repaying this loan, and they're just throwing money at people, assuming underlying the housing market's going to go up forever. And then you have layer after layer of speculation, insurance, and reinsurance that everybody's making money on at every step of the way. Have I got it right?
Essentially, yes. The other thing,
and then they're going to hide it in the Caribbean. Go on.
The other thing about a subprime is it's a trick name, really. Subprime makes it sound like it's a lower interest rate, but the subprime loans were always higher interest rates. And after subprime, after 2 years, adjusted generally upward every 6 months. And so these people who would move into a home with a $1,000 payment might have $2,000 payment 3 years later.
Now, I've been told by some of the economists I've interviewed that some analysts believe as much as a third of the world global capital flows are offshore in tax havens, unregulated and untaxed. So this is where a lot of the subprime went.
That's right, and the estimates of these instruments that I described, they're known as CDOs, collateralized debt obligations, reached $1.3 trillion. There also have been estimates that 25 to 50% of the subprime mortgage securities that were packaged and sold by Wall Street firms ended up in foreign hands. The International Monetary Fund has estimated that global losses from the subprime meltdown could reach 2.7 to 2.8 trillion. Now, bear in mind, just the basic good old subprime bonds, or there's a related group that's slightly less risky, were also sold to foreigners. But one of the interesting things we discovered is that the foreign banks don't even want to say where they bought these bonds or more exotic securities sold out of the Caymans. They won't even acknowledge. And we asked whether Goldman Sachs had sold them to them, and nobody is pointing any fingers.
Why is that?
Well, I'm not able to assess motives other than guess, but Goldman Sachs is a really big and really powerful company. It's the most prestigious investment bank in the world.
And far more powerful now post-subprime crisis.
It appears so. And I talked to a German bank official who will remain unnamed. He said that the AAA rating was the clincher for us. And if you think about how these AAA ratings were bestowed on these securities, the Wall Street rating agencies, the big three, Moody's, S&P's, and Fitch, would have a meeting, according to Wall Street bond experts. They'd have a meeting with Goldman Sachs or another big investment bank, and there'd be a discussion about what was going to be in this bundle of subprime mortgages. And then they would part company, and there'd be a phone call made, and the ratings agency might say, "We think we can handle this." And what the Wall Street Investment Bank wanted to know, of course, is, can you give us AAA ratings on the bulk of these securities? And I've had one expert say to me, basically, they were like a high-price escort service. They were just haggling over the price.
But there's no quote-unquote due diligence. It almost seems oxymoronic, to use the word in this whole case. There's no diligence being taken place. It's all wink, wink, nudge, nudge. Let's get in on the feeding frenzy.
The Wall Street firms did hire due diligence contractors to go through the mortgages before they bought them. But the problem was the mortgage bankers, subprime lenders, had adopted such loose guidelines that when they were reviewing the loans, all the loan had to do was fit the guideline. And if the guideline was, what they called a stated income loan, which later became known as a liar's loan, there was no verification of the applicant's income. And so if there was any kind of a protest by one of the due diligence contractors saying this loan should be rejected, a supervisor would step in and say, we have to follow the mortgage lender's guidelines.
In the next segment of our interview, let's dig into this, because you analyzed one specific case. In fact, where some of these people doing this diligence,
right,
we're told we're not very interested in what you're saying, and more than that, a competition amongst Wall Street banks to get at these subprime mortgages, and one way to get at them is not to ask for any due diligence. And in fact, the less you wanted, the more you got. So in the next segment of our interview, let's dig into how all of that worked. Please join us with Greg Gordon on the Real News Network.